Welcome to OptionTiger.com. This is Harry Swaminathan. Let's say you wanted to get some leverage on the SPX itself. Now, we all know that the SPX is a big index. So if you come here and you look at the SPX is trading for about 1523. And so if you come to the SPX options, and let me hide some of my positions. So if you come to the SPX options, and let's say you go out about a month or so, so we come to the April series, we can see that at the money calls and puts are going for approximately $28 to $30, $24 to $28. So those, SPX is a big index, and most people may not want to trade this index for many reasons. You can see the bid-ask spread for, first of all, is 2460, 2570, 2750, 2870. So it's over $1 just on the bid-ask spread. But what if you wanted to play the SPX, but you also feel that the SPY is a little too small? So if you see the SPY is 1/10 of the SPX, and the SPYs are very small. So, and there's nothing wrong with the SPYs. In fact, they are one of the most liquid options in the market. You can see the bid-ask spread, for example, is 1 cent, and you can't get any better than that. But let's say you wanted a little bit more leverage, because here you can see today the SPX is up 6 points. So let's go back to the SPX. It's up 6 points. And so 6 points is approximately, I would say, 4/10 of 1%. But let's say you wanted a little bit more action, and you wanted an instrument that was just like the SPX, somewhat bigger than the SPY, and had a little oomph to it. So that's exactly what we're going to show in this video. We have an instrument that's called the SPXL and the SPXS. The SPXL is a long and the SPXS is a short. So this is the SPXL and the SPXS. The SPXL is the long version of the instrument, and the SPXS is the short version. So if you were bullish, you could buy calls on the SPXL, and if you were bearish, you could buy calls on the SPXS. Now you're only going to buy calls because it's an inverse instrument. So I don't want to get into that right now. We're just going to look at the SPXL, and it's trading for about $106. And if you look at the description of the SPXL, it's a direction shares S&P 500 bull 3x. Okay, so this is 3x. So which means for every 1% move in the SPX itself, the SPXL is going to move 3%. So you can see, if you look at it, the SPX today is up 6 points. We said that was going to be about 4/10 of 1%. The SPXL is up by $1.41, and as a percentage of 106, you can see that's going to be about 1.2%. So for 0.4% increase in the SPX, you're going to see 3 times, which will be 1.2% or 1.3% increase in the SPXL. So what does this mean for us? It means that you're going to get 3 times the movement of the SPX in this particular instrument. And it's obviously going to be a little bigger than the SPY because it's 3 times. It's a triple leveraged. And in general, when you're dealing with triple leveraged instruments, you don't want to hold these instruments for a long time because there are all kinds of longer term errors that creep into these instruments. But if you're going to trade it for a week or two, this is perfectly fine. And especially if you're dealing with the options, it's perfectly fine. So the other issue that you have to watch out for in the SPXL and the SPXX is that the bid-ask spread, you'll see it's not that wide. It's about 30 cents. But 30 cents is quite a bit. So it's not going to be like your normal bid-ask spread for a $100 stock, you would probably see the bid-ask spread be between 5 to 10 cents, maybe 5 to 15 cents. And here you see it's about 30 cents. Sometimes it'll be 40 cents. So you're going to give up a little bit of slippage on the bid-ask spread when it comes to the SPXL and the SPXS. However, on the flip side, if you get the movement you're looking for in the SPX, and rather than trading the SPX itself, which is a very large index, you can definitely trade these. And for the same April series, you can see now you have your option prices are in the $6 range, whereas we saw on the SPX, the option prices are in the $24 and $25 range. And not only that, you're going to get 3 times the movement. So there is an inbuilt leverage into this instrument that will give you 3 times the move. The chances for making a profit are increased because of this 3x leverage. However, the 3x is going to work for you on the downside as well. So in all these cases, you always have to remember that leverage works both ways, on the upside as well as the downside. But if you wanted an instrument which had a little bit more power, which had a little bit more movement, then the SPXL certainly would fit that bill. And the other thing also you have to watch out for is, let me put the volume and open interest over here. So you can see the volume today. There's only volume on a few different options over here in the April series. But however, these instruments are new. So you're going to see low volume for some time as these instruments start becoming more popular, more people know about it, and hopefully, like, if you haven't heard about these now, you've heard about these instruments from now. But you can see the at-the-money options have an open interest of about 200, 100, 155. So it's not great by any standards, but I think over a period of time, let's come and take a look at the March series and see what the open interest is on the at-the-money options. Yeah, it's not a whole lot. So there's quite a bit of development that needs to happen on these instruments. So perhaps in about 2 months, 3 months, 4 months or more, we'll see more interest in these options. So you have to watch out for the open interest because these levels are not great. And that's why you're going to see the higher bid-ask spread, because it's thinly traded, the liquidity is low. The other thing you have to watch out for, well, you don't have to watch out for, but you have to be aware of, is the volatility levels on these options. You can see that they are between 40 and 46. And that should make sense, because if you look at the VIX index, which is the volatility of the SPX, that's 14%. So you're going to see a volatility level of about 3 times on these instruments, because they are triple leveraged. So this should not come as a surprise. This is what you would expect to see. However, what we may need to do is wait for the popularity of these instruments to go up some more. And if we can see open interest close to 1,000 contracts, then it becomes a fairly well liquid instrument, and it's definitely tradable at that point. So hopefully you enjoyed this video. If you have any questions, please send us an email at info@optiontiger.com. Thank you.